you for subscribing, for your comments, for your shares. You are so amazing. Thank you so much. Today we continue with the series Learn Accounting the Basic Way. In this class, today I will just try to summarize what you need to know about debit and credit and assets, liabilities, equity and all that of a business. Okay, as you rightly know from the first class of Learn Accounting the Basic Way, we said that every transaction has two entries. One is giving, one is receiving. The one that is receiving is the debit side. The one that is giving is the credit side. The debit side is the left-hand side. This is debit. And the credit side, the one that is giving, is the right-hand side. Right-hand side. So this is giver, this is receiver in any transaction. Now, we understand that, okay, every business asset is secured by the fund of those who own the business and the funds that are borrowed from outsiders. Basically, assets which are items of value that are owned by a business, by an organization. They include those ones that can be used for many years, like machinery, like plants, like land and buildings. And we have those that can be used up within 1 year, like your inventories, like your trade receivables, your debtors, basically. Now, those assets put together are obtained or secured by the funds of the owner. The funds of the owners is what we call capital. And the funds obtained from third parties, liabilities. Hence, the account equation is assets is equal to capital plus liabilities. Assets are items or property owned by a business. Capital is funds generated by the owner or equity of the owners to the business. But sometimes the business will have assets that is more than capital. That means the remaining part was by the third parties, like the money the business borrows from the bank or overdraft from the bank, loans from creditors, loans from lenders to a business is liabilities. Now, I want to now summarize the basic entries that will go to debit side and those that will go to credit side. I want to summarize that for you to really understand it so easily. I will put it as an acronym, DEADCLIP. If you look at this, it sounds easy, right? Okay, I suppose it sounds easy. DEADCLIP. The debt are items that will put in an acronym that will go to the debit side every time. The clip will be the items that will go to the credit side every time. It's just a summary to help you. D here, the first one is debtors. So that means debtors will have a debit entry normally. Debtors are customers that the business transacts with that at the moment owe the business. They will usually have a debit entry. Why would debtors have debit entry? It is because debtors are customers that receive goods at the moment that have not paid back. So that is why they will have debit entry. The E here stands for expenses. Expenses are incurred by the business. Example like wages, like salaries, like electricity bills paid. They will have debit entry because the business incurs them. That means the business will enjoy those values. Then, if the business pays in cash for those expenses, then cash goes out. Then the item here, like wages, being given by the workers of the business, will be enjoyed, is received by the business. That is why it will be in the debit side. Then we have all assets by the business. We have debit entry. Items that the business owns that are received at the point of purchase. We have debit entry. And lastly, drawings. Drawings are takings or withdrawals by the owner for personal use. The business entity explains that the owner is treated separately from the business. So when the owner takes from the business things that belong to the business for personal use, like withdrawing money from bank for personal use or using business assets for personal use, that is seen as drawings. Because something is being withdrawn from the business, it is being received by the owner, and we record that as drawings. If you see DEAD, all these items will have debit entries. Then these ones will have credit entries. Normally, the first C here is creditors. Creditors are individuals, firms, organizations that the business purchases from on credit. That means at the point the business owes creditors. Creditors are individuals or firms that the business owes at the moment. So they will normally have credit entry. Why should they have credit entry? Because creditors are givers of goods, givers of inventories. Do you get it? They give goods, they send goods to the business, and at the point do not receive anything, any cash. It does not mean that they won't be paid later. But at the point that they are sending the goods to the business on credit, they do not receive anything. That makes them creditors, and they will have a credit entry. All liabilities will have credit entries. Liabilities are obligations or indebtedness of the business to the third parties, to outsiders, like bank loans, like debentures, like bank overdrafts. They are liabilities, and they will have credit entries too. All income will be in the credit side. Why should income be in the credit side? Because income, like sales of the business, for instance, when you sell goods, you earn income. By that point, your goods go out. When goods go out, when goods are given out, then you credit right hand side. So all income, including sales, will be in the credit side. This P, there is P square. You get it? There are two P's that will also have credit entries. They are provisions. Oh, sorry. It is here that I have C square. I'm sorry. C square here, I have two C's. But provisions here, let me explain that first. Provisions are guiding against future losses or future expenses to incur. For instance, you can provide for depreciation of your assets. You can assets that are expected to last for more than 1 year, like plant machinery, land and building. They're expected to last for years, at least more than 1 year. Now, these assets, you provide certain amount of reduction, of diminution on this value, on these assets. When you prepare that, you reduce the value of assets. Now, let's come back here. Assets will have debit entry because at the point of getting them, they are received to the business and they are debited. Now, year in, year out, they reduce in value, and provisions are set to reduce the value of assets. Hence, if assets will be in the debit side, provisions which reduce the value of assets will be in the credit side. Now, back to the second C here, that is capital. So capital is the amount or fund or item or of value that the owner gives to the business. It is treated as capital because the owner in the first place is treated as a separate entity from the business. That means when the owner gives to the business, it's capital, credit it. And when the owner takes from the business, what's it called? Drawings. That's debited When the owner gives to the business, it is capital. So the summary of it is that all transactions will have two entries. But the basic thing about it is that these transactions we normally have debit entries, left hand side, debtors, expenses, assets, and drawings. While creditors, liabilities, income, provisions, and capital will have credit entry, and I call it DEADCLIP. Isn't that fun? Thank you so much for watching this. Enjoy the time.
To make plenty bloopers because we don't have bloopers. I'm joking.
I want to see.
No.
Covering
No,
Yeah.
Okay. Wait.
My sweet, are you?
Can you see cover
Those
this
are
side
actually mine.
and this side?
But
Oh, so sorry for that.
remember, if you working, technical difficult.
Yay.
Okay. How long?